So the next one we got to talk about is the DLUV, right? That direct labor, the direct labor usage variance. Okay, so the direct labor usage variance tells us that it's the labor, right? It's the usage of the labor. So those number of hours that they've worked, that's what's changed. That's what's driven the cost changes. The number of hours that worked, okay? When we do that, we find that by taking the actual hours worked less the standard hours allowed for the number of units produced. So this is going to be if it takes a quarter of an hour to produce 1 unit and we actually produce 3,000 units, that is what our standard hours allowed for the number of units produced will be. So you take your actual hours worked, less those standard hours, times the standard price, okay? So if your actual hours worked are greater than the standard hours allowed, then the variance is going to be a positive number. This indicates an unfavorable variance, right? It is higher, okay? If the actual hours worked are less, then your variance is going to be a negative number, indicating that it's a favorable variance, okay? So let's take a look at the following example. I mean, this follows the last variance, the DLPV that we talked about, right? Follows the same kind of concept. Okay, so if we have $800 hours, those are the actual hours that we worked. Okay, and the standard hours allowed for producing 3,000 units would be 750 hours. You'll note here it's that 3,000 times 15 minutes, or a quarter hour, gets you that 750. So actually worked 800, we say the standard is 750, we multiply that times the standard price, our budgeted price. That tells us that it was a $400 unfavorable variance. We got that positive number, right? I need to change that note, so ignore this note right here. But we're not going to show this $400 as a positive number, we're just going to denote it as unfavorable. So $400 unfavorable. Okay, and it's positive, so it's unfavorable. It cost us more than we said it was, so it's an unfavorable variance. This table right here, I would write down everything in this table, or take a screenshot of it, or clip it out of the slides that I provided to you guys. You will want to know these. Okay, these will help you out tremendously come exam time. Next thing we got to talk about are these material variances. So we're going to have 3 different material variances. We're going to have a usage, a price, and an inventory variance for materials. So if the actual amount of direct materials is different than the budgeted amount of direct materials, we have 4 possible explanations here. It could be that the amount that we paid to purchase the materials was different than the standards, right? That's your price variance. It could be the amount of materials that we used was different than the standard. That's your usage variance. It could be that the amount of materials purchased was different than the amount that was used, right? That's going to be your inventory variance, right? So you're going to have some left over. You don't have enough, whatever the case is, okay? Or it could be some combination of any of the 3 explanations above, okay? So in order to analyze these explanations, find out what exactly is happening, we're going to calculate a direct materials price variance, a direct materials usage variance, and a direct materials inventory variance. Again, this box outlined in red here, I would find a way to make sure you have access to it in your notes. Write it down, get familiar with these formulas. These are probably the trickiest part of this chapter. It's just memorizing these formulas and when you're going to use them. Okay. So the direct materials price variance, or the DMPV, this tells us that the difference in material cost is due to a change in the amount that we paid to purchase the materials. And we find that by taking the actual price per item purchased minus the standard price per item purchased times the actual amount of material purchased. Okay. So if the actual price is greater than the standard price, then it's going to be a positive number. This indicates, once again, an unfavorable variance, right? We actually paid more for it than what we thought we were going to have to. We paid more for it than what we budgeted to pay for it, okay? If the actual price is less than the standard price, then it's a negative number. This indicates a favorable variance for us, right? We paid less for it than what we thought we were going to. So let's take a look at a really quick example here. Let's say we're going to look at these processors. So what we actually paid was $210. What we budgeted for was $200. The difference there, the variance of the two, is $10. What we actually purchased was 3,500 units. So this being a positive number ends up as an unfavorable variance, right? We paid more for these processors than we had budgeted for. Now let's take a look at the DMPV, the DMPV for our components, right? The direct materials price variance for our components. What we actually paid for components was $24. What we budgeted for was $25. So we have a negative $1 favorable variance for us, okay? Multiply that times the actual number that we purchased, which was 8,000, and you end up with negative 8,000, which turns into a favorable variance for us, an $8,000 favorable variance. Okay. The direct materials usage variance. This is what indicates that the change in cost is due to the amount that we used. Okay, it's the amount of materials used per unit, and that's going to be important to realize. It's per unit. Okay, so we calculate this as the actual amount of materials used less the standard amount of materials allowed for the actual number of units produced. So how much are we allowing for? So let's say that the standard was, 3,000, right? And we used 30, 50, okay? And then we're going to multiply that times the standard purchase price. Again, we'll go through this again. If the actual amount of the materials used is greater than the standard amount, then you have a positive number. This indicates an unfavorable variance. Why? Well, it's because we used more than we thought we needed to. We actually used more than we budgeted for use. If the actual amount of materials used is less than the standard amount of materials allowed, then it's a negative number. This indicates a favorable variance for us, right? This says we used less than what we budgeted for. Okay, so here we go. We'll take a look at processors. What we actually used was 3,050. What we budgeted for was 3,000. So this is going to be a positive number, positive 50 times 200. That's our that's our standard price. That gives us $10,000, negative $10,000. That's an unfavorable variance for us, meaning we used more than we thought we were going to. We used more than we budgeted ourselves for. That's an unfavorable variance. We look at components. What we actually used was 6,000. What we allowed for was 6,000. So that's 0. 0 times the $25 per unit is $0. So there is not a favorable or unfavorable variance there. Talk about the last one here, the direct materials inventory variance. So what this tells us is that the change in direct materials cost is due to the different quantity of materials that we used, right? Or purchasing a different quantity of materials than what we actually used. So we purchased more, we purchased less than what we actually needed. We calculate that by taking the actual amount of materials purchased minus the actual amount of materials used in production, and you multiply that times your standard purchase price. So if the actual amount of materials purchased is greater than the actual amount of materials used in production, the inventory variance is a positive number. This indicates an unfavorable variance. You over-purchased, right? You purchased more than you actually needed to. So for example, let's take a look at processors. We actually purchased 3,500. We only used 3,050 of them. The standard price is $200. That's a negative $90,000. A positive $90,000 unfavorable variance. We have $90,000 of that cost, if that change in direct materials is due to us using less than what we said we needed. Okay? Same thing with components here. We have a $50,000 unfavorable variance, and that's because we used less than we purchased. Okay? So the implication here is that the cost of direct materials was $140,000 higher because some materials that we purchased weren't actually used in production. Now, this may not be a problem if you can use them for the next production run, but let's say for some reason you have to sit these in a warehouse. There's been a bottleneck. Whatever the reason is, you're not going to be able to use these components in production for another month, and they obsolesce. Well, now you have $140,000 worth of materials that are no good to you, right? So this causes problems, and this is why scheduling that production scheduling is so important, because you don't want to run into big problems like this. Okay. So if we wanted to use variances to explain the differences in budget to actual, this is what we call a budget to actual analysis. Okay. If you put all the variances together, you can now look at why budgeted costs differ from your actual costs. Okay. This is very important for management, because each period they will use these reports or this analysis to budget and plan for their future periods. Okay. So essentially, to read this chart, you're going to start with your actual column right here. Okay. You're going to subtract any unfavorable variances, and you're going to add in any favorable variances, and you will arrive at your budgeted results. Okay. You'll notice that our actual results and our budgeted results are the same as when we did the very high level variance analysis, but here we've broken it down. What was the cause? What was the main root cause of the variance for us? Well, it looks like it was inventory variance, right? Maybe we need to reevaluate our standards, right? So maybe our standards were too high. Maybe we need to reduce those so that we cut this cost down, right? So, all right. Well, if you guys have any questions, please contact me. That is it for Chapter 9. I will get your homework out to you shortly. Just let me know if you got any questions.